Mr. Ravichandran, can you hear me now? Mr. Ravichandran, have you started? Can you hear us? Mr. Ravichandran, can you hear us? Yeah, he's coming. Hello?
It seems his audio is not connected.
Yeah, okay. Mr. Ravichandran, can you hear us? Have you joined the session? No.
Good morning.
Good morning, Mr. Upasak.
Yeah. Let me know when should I start the session.
Yeah. We'll start 2 minutes. Good morning, friends. Welcome to the second session of the workshop on option pricing models. Mr. Upasak Shah is our today's speaker. He's the co-founder and director NoCraft Analytics Private Limited. Upasak has over 13 plus years of professional work experience with expertise in valuing companies across various industries. At NoCraft, he leads complex valuation and consulting engagements. He has proven expertise in valuing derivatives and embedded securities using complex models such as lattice or Monte Carlo simulations. Mr. Upasak, over to you.
Hi everyone, good morning. Thanks for joining in so early on a Sunday morning. It's a pleasure to have such a large audience. So in today's session, we would start with valuing compulsory convertible preference shares using option pricing method. I've shared my screen. Please let me know if you cannot see the PowerPoint presentation on the screen. Okay, I'm assuming everybody can see now.
Yes.
Just give me a second. Okay. So, we start the background of CCPS. So, in recent years, investment in venture-backed companies in India, that is the startups in India, has increased a lot. We have seen many companies, venture-backed companies are investing in startups across different industries in India. And this venture capitalized doesn't directly invest in common stock equity of such companies, since there are certain investment security provisions which they need to model in for the investments. Hence, a new kind of a security was developed which is called CCPS, which gives the benefit of downside protection to the investor, and also in an upside scenario wherein the company is going public or getting acquired at a higher valuation, then such investment can convert into common stock equity and the investors can get a higher return on their investment. CCPS is regulated by the Companies Act.
Upasak, one second. There is
Yes,
some background disturbance noise. Uh, so maybe you can switch off fan or something in case it's there.
let me switch on to my headphones.
Some background noise. Better to switch off any ceiling fan or any such background noise. Still, that background noise is there.
Yeah, just
Friends, meanwhile, some announcements I would like to make. Uh, Whoever has participated the session yesterday and today, only they will get the credit hours. And please stay with us till the end of this meeting. Yesterday we tried out breakout rooms. Few of our members had a very wonderful networking or just a bonding with the fellow registered valuers. So today also we will be giving that option in the end, breakout rooms. So you can stay and then you can join those breakout rooms towards the end of the session. And I request the members to not to share any such joining links as today's session in the group, because definitely this is a paid session. That is why we definitely wouldn't want all the members to get this joining link other than those who have registered and paid for this program. And one more important announcement is yesterday we have discussed with ACBA. They have agreed to share the recording, but it will be on their platform, which will be we can view the session recording, yesterday's and today's. It will be available, I think, for 2 weeks or 1 month. We will be sharing that separately in an email. Yes, Upasak, over to you.
Silpa, is it okay now in terms of background noise?
Better, but you can be a little louder also.
Okay, perfect. Cool. So yeah, so I'll just continue where we left. So CCPS is basically issued as an investment security to such venture-backed companies or private equity players. So CCPS is basically like a combination of a debt and equity.
Voice is very low, please.
Am I audible now?
You are audible, but not very, it's a very low voice.
Please speak louder.
I think some adjustment is needed. Otherwise, the speaker should be strong enough to catch your voice
Yes.
clearly. Some adjustment may be needed.
Okay.
Please look into.
What about now? Is it okay now?
Yeah, it is better. It is better.
Okay, perfect. Okay. So I'll just restart. So CCPS is basically issued to such venture-backed companies as a part of the investments in such startups, which are privately traded. So CCPS is a combination of both debt and equity, wherein they will invest few $1,000,000 or few lakh rupees as a initially as a debt, but if the value of the company increases and the payoff to the investors is higher than the debt plus interest, then in that case they may choose to convert into equity. Hence, it is CCPS is defined as a quasi debt and a quasi equity like instrument. Since CCPS is not issued as equity directly, it has a life of 20 years. It can be for a shorter period, but the life cannot exceed 20 years from the date of issue. CCPS is regulated by the Companies Act. It is also governed under FEMA if an investment is made by a foreign entity. And there are also tax implications of CCPS. But in today's session, we will not be discussing about the regulation around CCPS. Objective for today's webinar is to understand how an option pricing method is used to value CCPS. And, and you can always pause me if you have any questions in the interim. So what is a CCPS instrument? The CCPS has certain rights which makes it different than a pure equity investment. So CCPS first receives the right to liquidation preference, which in most cases is equal to the investment made in the company. So for example, if an investor invested $1 million in a company, and if the company was acquired for $1.5 million, in that case, CCPS would be paid first $1 million, and then the remaining would be distributed to other shareholders. And if the same company was acquired at a much higher valuation, in that case, CCPS may choose to forego its liquidation preference and uh, convert into equity securities. This structure is pretty much similar to what we have seen in United States, wherein such venture-backed investments has been going on for many years now. In United States, such investment is referred as preferred securities, which is very much similar to CCPS, which, with small differences. So now I will move to option pricing method. Any questions on CCPS?
Yeah, hi, Upasak. Pranav this side from Delhi.
Hey,
Uh,
Pranav.
Hi, just wanted to have a general overview that why all the deals are structured in a way wherein the CCPS takes the major component of the funding and the equity portion is very minimal to, let's say, a one share or a two share. I mean,
So you mean to say why CCPS takes, okay. So this is just to give a protection to the investor. Let's say if an investor
right.
invests in a startup company, and if the company fails to deliver, or if after investment is made for let's say $1 million for 10% stake in the company, and if the company is sold for $2 million, in that case, the equity investor would only receive $200,000 on his investment if it has received a 10% stake. So that was very risky because there were many companies which were formed earlier wherein they took the money as an equity investment and then they would sell the company at a very low price, which brought huge losses to such investors. Hence, they designed this structure which gives some sort of a downside protection to the investors. The reason is the first proceeds will be paid to the investment amount which was made by such investors. So Ravichandran has a question about how the downside in the value of CCPS is protected. So in a downside scenario, CCPS is treated like that. Hence, so if after all the liabilities are paid and like any secured debt is raised by the company, so that will be paid first. Thereafter, all the proceeds will be first paid to CCPS, and then the remaining proceeds would be paid to any equity investors. Yeah, so is the purpose of one equity share alongside. So one share is basic sometimes issued uh, to show that there is also an equity component to it, but in most cases it will convert into much higher number of shares and not into one share. So again, it depends on the tax implication of how the structure is designed. So we'll now move to option pricing method. So how is an option pricing method used under to value CCPS? So in yesterday's session, Dhara had explained the 5 different components on option pricing method. How do we determine the value of a call option? So today we will take that training and move forward about how we implement an OPM methodology in valuing a CCPS. So in theory, CCPS is like a call option under company. So let's say an investor invested $1 million in the company. So you are buying a stock, you're buying like a call option for $1 million. And if the value of your stock exceeds $1 million, then you're in the money. And if the value of the stock is below $1 million, then you're out of money. So it's very much similar to a like a call option. You would be your payoff would be positive if the value of the investor made by you exceeds $1 million. So hence you're buying a call option on the company by your investment. In an option pricing matter, you will also consider what are the rights and preferences to the CCPS. In Indian context, there are not specific rights which are different in nature, except they are the first right of receiving the payment in a downside scenario.
Normally, Upasak, what happens is when the company comes up for issue of CCPS or OCPS, and they come to us for valuation, we normally give enterprise value and per equity share value. Is it the right approach?
Yes, so we will determine our how do we get the per share value. By the end of this session, you will understand how the per share value of the CCPS determined using an option pricing method.
So ideally, we should not give equity share valuation when the present issue is CCPS or OCPS or CCDs.
Yeah, so equity share valuation is required as as an input because you need to determine what's the current value of the company in order to estimate the value of CCPS.
Okay, and the pricing of CCPS should not be less than what we have given the value of CCPS.
Yeah, ideally it won't be less.
Okay.
Upasak, just one more question here. You've written in your slide you're discussing using the Black-Scholes model, but practically the agreements that we read for the CCPS issuance, they are more of American options, right?
Uh,
Rather than European-based options. So would Black-Scholes be the correct way to value CCPS?
Yes, generally, an investor won't prefer to exercise the right of conversion prior to an exit or a liquidation event because there is no benefit to convert earlier and get equity in a company which is whose security is still illiquid. So, and in theory, uh, an investor, an option holder will never exercise the option in an illiquid security before its maturity date. So in that case, whether it's American or a European option, it won't matter a lot.
No, I'm just saying that there is no fixed date of expiration in case of the CCPS, the term sheets that we read.
Yes, that's
I
right.
mean, so there is like three, event qualifiers, I would say. I mean, listing and, I mean, you must have,
Yes, that's right.
yes.
So in
So
that,
yeah, please.
so in that case, what we need to do is we need to determine an expected date of exit based on probability of each scenario taking place.
Okay.
Will you, to add to Pranav's question, will you also be covering basically the different series of CCPS as also the different conversion to equity ratios?
Yes,
All right. Thank you.
we would include like A, B, and C rounds.
Wonderful. Thank you.
So as per your view, Upasak, I mean, you would give more preference to the Black-Scholes over the binomial?
Ideally, you should get answer very close to each other, because even in binomial, you will assume a certain term to exit,
Mhm.
and same thing in black scores. In my experience, applying both the methodologies will give an answer which is pretty much close to each other, unless there are certain nuances which cannot be captured in a black scores. In Indian context, there are not such nuances in issuance of CCPS, but when we do valuation for US companies, at that point of time, they may have different rights and preferences which may not be captured in the Black-Scholes models. Hence, we may use a lattice model for such underlying securities.
No, but
Thank
the
you.
answer would in any case be different if, for example, the dividend or the coupon rate of the CCPS structures are different in various series.
Yes, then in that case, what we do is we can add the coupon rate. I'll cover that in the later slides, but we can add the coupon rate to the future payoff to the CCPS holders.
But would you then calculate the NPV for that first to add it, or to just take the coupon as per se?
We will just take the coupon as per se until the date of an exit taking place. In most cases, such startups doesn't have a positive cash flow. Hence, it is very unlikely they would be paying coupon until an exit taking place. So we'll move on
Just to and
to.
take the questions little later.
So we'll move on to the Black-Scholes model. So as discussed earlier, there are 5 critical inputs or 5 variables which are used in a Black-Scholes model. A stock price, which is nothing but the equity value of the company as of the valuation date. Then the expiration term. So its term basically is an expected term or weighted average term of different scenarios likely to occur in the upcoming years. So if there are 3 exit events which are likely to take place, then we can basically do a probability weighted approach to determine what's the expected term of folding of the CCPS. Then the risk-free rate, which is pretty straightforward. Volatility, which was covered by Dhara, we'll use the same approach which Dhara discussed yesterday. And the strike price. The strike price is something which is different. So we will spend some time discussing how do we determine the strike price required to value the call option in a Black-Scholes approach. So what are the steps which we need to apply to get to value of a CCPS share? We will also take a practical example in the coming slides. So the first step is determination of the strike price, which we will cover in the next slide. Then step 2 is determining the tranche value, which we'll also cover. Then the allocation of value, distribution of the tranche value, and then determination per share value. So these are the 5 steps which we need to follow. And then I've shared an Excel workbook with everyone. You can open that workbook, and we will take that example about how do we determine the waterfall, the call option value, and allocation of value. So I will move now to the Excel spreadsheet. And I'll just share my screen in a minute. So I've shared the Excel spreadsheet. Let me know if you cannot see it.
Was this sent yesterday?
Shilpa would no. Shilpa, can you answer to this question? When was it shared with the
It
participants?
was shared yesterday, and I will be sharing again in the chat. It was actually shared in the chat also. I'll be sharing it again in the chat.
Okay.
You would have got an email yesterday from BBA.
So in meanwhile, I can just start with the example on my screen. You would actually require the spreadsheet for the case study, which is on the next sheet. So this is the same example which is in the PowerPoint presentation, but for better explanation, I've recreated it in the spreadsheet. So this is the scenario in which we have currently 2 CCPS rounds which are issued by the company for a capital investment of 30 million rupees, 15 million, and common stock was issued for 5 million rupees. Now, when an investment is made, in most cases, you will have this information. What was the company's value for CCPS conversion? So you may not have this information, but I will show you how can we compute number of shares and issue price if we know the investment made and the company's value for CCPS conversion. So in this case, Series A CCPS was invested up to 15 lakh rupees, 15 million rupees, and with a conversion value of 50 million rupees. So which means the per share issue price of CCPS is 7 rupees, which is computed as the value of the company less the investment made in CCPS. So it will be, so this is nothing called but the pre-money valuation as of Series A CCPS. So pre-money is a very common term used by investors when they invest in a company. So if they would always negotiate on the pre-money valuation of a company, and thereafter they would get to the number of shares and the issue price. So in this case, the pre-money is 35 million rupees. And this 35 million rupees is available to the shares which are issued prior to Series A CCPS. In this case, it is common stock, which is 5 million shares. Hence, the issue price of CCPS should be 7 rupees per share. So this is the same thing which were computed. So we basically did the same math: 50 million minus a 15 million rupees divided by number of common stock which are already outstanding. So that get to 7 rupees per share. Then we take 15 million rupees divided by 7 rupees per share to get to number of shares to be issued to CCPS shareholders. We do the same exercise for Series B investment. So the pre-money for Series B is 70 million rupees. And before Series B was raised, Series A and common stock were already outstanding. Hence, the way we will compute the per share value would be 70 divided by sum of Series A and common stock. That will get to 9.80. And then you get a number of shares. So this data points can be computed if we are aware about the pre-money valuation of the company or the post-money valuation of the company. I'll take a pause here. Any questions in understanding the cap structure?
Had it been post money, then how the valuation would have derived?
So this is the post-money valuation, like 100 million rupees, and investment was made up to 30 million rupees. So the pre-money is nothing but post-money less the investment amount.
Okay.
How did you get the number of shares, Upasak, in D4 and 5?
Okay, so let's start with D5. So we know the post money was 50 million rupees.
So how did you arrive at post money valuation of 50 million?
So this would be known to us when the investors would negotiate with the company. So the cells in blue, the blue font data would already be known to us because this is how they will negotiate the investment in the company.
So is post money valuation an enterprise value of the while we do the valuation DCF and other methods? So we arrive at the valuation.
Not real.
Or is it the market negotiated deal price?
It's a market negotiated price, but not necessarily the enterprise value of the company.
Okay.
When you took the denominator for Series B, that is the 21,42,000 shares, you assumed that the CCPS Series A is converting at 1:1 then?
Yes. That's the assumption here, that conversion ratio is 1:1.
Okay.
So, but 125 million value of company, that is enterprise value, is it?
As of today. So this investment would have been made sometime in past. Okay, let's say. But if you're, let's say, valuing the company as of today, then what was the valuation of the company using a DCF or a market approach?
Okay.
Could you repeat that 1:1 conversion, and can you go to the 4.
Out is 35 million is supply.
Okay, so I'll start with here again. So the post money which was negotiated between the investor and the company is 50 million rupees, and the investment which was supposed to come in is 15 million rupees. So pre-money is post money less investment amount. This is how the pre-money is determined.
Is there a justification required to be mentioned about the pre-money valuation in the report?
No, this is just a market-driven input. You are not, the appraiser is not required to estimate the pre-money. Pre-money is simply the post-money less the investment amounts, and this post-money investment value and the investment amount would be known to us as a part of the investment done in the company by the investors.
But what if that conversion needs to take place at a fair market value of the company?
So on the date of investment, it should be at a fair value. So in other words, the per share value of Series B CCPS on the date of investment should be equal to its fair value.
Could you please repeat that?
No, this Series A, Series B conversion would happen at a future date.
Yes.
Okay. And it was written that this conversion would take place at the fair market value at the time of conversion.
So it depends on the
after 20 years or 10 years or 15 years.
So it depends on the terms and condition of the investment. So in certain cases, they will determine a fixed number of shares which will be issued to the CCPS holders.
Okay.
So in this case, what we are assuming that if the shares to be issued to CCPS is a known amount, which is 2 million shares, irrespective of the value of the company on a future date, then how the payoff would look like. If it was to be issued at a fair market value, then we don't have to do this entire exercise.
No, what I meant is we don't know the price after 20 years. Okay, we need to do the present value of this. The valuation of CCPS at the current rate, as if the conversion is happening today.
As of now, yes. As of the issue date, yes.
Okay.
Okay, so
But
moving.
can you share, Upasak, can you share what will be the steps in case conversion has to happen at fair value? Because what I understand is as per FEMA, the rules say that yes, the conversion should happen at the fair value at the time of conversion.
So that happens on the exit date. But currently, what we are valuing is as of the issuance date or in the interim date, not as of the exit date.
Upasak, can we say if Series A CCPS actually was issued, say, 2 years back, at that point in time, a registered valuer would have arrived at a pre-money valuation of 35 million. That is how that 35 million is arrived. Can we say like that?
Not really. So when the investment is made by the company, so by the investor in the company, they would have negotiated a post-money valuation. So for example,
only question left is that let's say those are issued 2 years back, and as on 31st March of the reporting date, we need to value the option value again, because in CCPS we need to value the option, okay, option element in this CCPS, the conversion element of equity element. Then as on 31st March today, we need to again value as per DCF or any other method also, because it is 5 CR here or 10 CR here is the value at the time of issue of shares. I presume it is 2 year, 3 year back, but we need to value as on date, and conversion would happen at future date.
Correct. So what we are, let's say we are valuing as of the current date, as of 31st March 2021, and CCPS was issued sometime in 2020 or
Correct.
2019.
Correct.
So as of today, that is 31st March 2021, what is the value of the company, equity value of the company? We use that as an input, and then do this option pricing method to figure out the value of the CCPS as on the March end date.
Correct.
Upasak, can you, I think the confusion probably here is what is the use case for this option valuing specifically CCPS? I mean, the company valuation is given. So normally it is required for from a portfolio manager's, I mean, it's a portfolio value perspective. Because
It is for the purpose of Ind AS.
So it's required for the financial reporting purposes
Financial report.
on your books as of the year end date to record what's the value of the instrument which is issued by the company to the investors.
So bifurcation between equity and liability to be done only at the time of issue of security. Once done, then it is not to be revisited.
I'm not very much familiar with that clause since
So what would be the strike price in this case if I need to value, because the value of the company is.
So we'll discuss that piece.
Okay. Oh,
so let's move on to basically figure out how the option method is appropriate and how do we use that in valuing the CCP.
Sir, let me say this. This capital raise is given and company's value for CCPS conversion also negotiated. We are not calculating that.
I'm having a hard time hearing you. Can you maybe type your question, just reiterate it?
Yes, sir. This company's value for CCPS conversion,
Okay.
100 millions, 50 millions, and 5 millions. How these figures have been ascertained? You are telling because of our negotiations, is it?
Sorry, how is this? So your question is how this is determined?
Yeah.
So this is not determined by the appraiser. This is known to the appraiser based on the investment negotiated between the investor and the company.
Okay, fine. How is 35 million is ascertained? I'm not able to understand.
So this is the pre-money valuation, 35 million.
Pre-money, how it is valued pre-money?
So pre-money is the post-money valuation less the investment amount.
Post-money valuation is how much is?
So this is the post-money.
Okay, 150.
Upasak, just a minute. This you are saying is post money, but normally we see that if some investment is coming into the company and we are doing DCF, and it is normally pre-money valuation if I'm not wrong.
So if you do a DCF without considering the equity investment which is made in the company, then that is a pre-money valuation. That's right.
But if DCF is done, then that investment is again we are showing it is investment in future. So it is always a post-money valuation you are saying?
So if the DCF is done, yeah, so that isn't DCF, we will get to the equity value of the company or the enterprise value of the company, and not
enterprise value is the post-money or pre-money?
It is a different than pre and post money. So post money is a market driven pricing between the investor and the company, which may necessarily may not beat the enterprise value of the company. So we'll park the discussion and we'll continue with the example, which is So I'll just do a refresh quickly. So in this company, there were two CCPS rounds which were invested across multiple years. So Series A was invested for 15 million rupees. B came in with 30 million rupees at the valuation of 50 million and 100 million. Series B has a higher seniority versus Series A. So when an exit occurs, first payment will be made to Series B CCPS, followed by Series A CCPS, and so on. So now, as we discussed earlier, there are 5 variables for using a Black Scholes model. So we discussed the four variables, and the 5th variable was strike price. So as I said earlier, we basically determine the strike price such that what will be the value of the call option, because each investment is a call option on the equity of the company. So for example, Series B CCPS holders have invested 30 million rupees. So they would be in the money if the value of the investment is more than 30 million rupees. So it's like it's similar to buying a call option. So in this case, we are basically doing 5 call options for each type of investment made. So the first strike price or the value call option is based on Series B receiving 30 million rupees. So let me maybe do a quick like a chart here. So let's say this is 30 million rupees. So from 0 to 30 million rupees, let's up to here, Series B will receive. Okay, so your first strike price would be 30 million rupees. So I will also recommend floor and a cap. Why floor and cap? We are saying that between 0, so when the value is more than 0 rupees and up to 30 million rupees on an exit date, the value will be first paid to Series B as a liquidation preference. So this is the range between which value would only be paid to Series B. Now let's say the value of the company increases beyond 30 million rupees. Then that payment will be made to Series A. Up to what? Up to 45 million rupees. So between 30 to 45, Series A will receive is $15 million back. So how is 45 computed? It is sum of 30 million rupees plus 15 million rupees. So now if you're doing this, so let's say you're doing here. Let's take this. So this is Series A. And the value of the company is 45 million rupees. So until this point, common is not receiving any value. Now, what will common receive? Common will receive if the value of the company is more than 45 million rupees, but up to the point wherein Series A converts to common stock. Now, this is very important. How to compute that? So, Series A, as we computed earlier, has a issue price of 7 rupees, which means Series A will convert to common stock when the value on a per share basis for a common stock is equal or greater than 7 rupees, which means common stock will receive 35 million rupees, which is 5 million times 7. So until the point common stock receives 35 million rupees, Series A will not convert. So that's how we have computed here. We have basically determined number of shares between A and common stock times 7 rupees, because common stock should also receive 7 rupees for Series A to convert. And since Series B is not converting, we add the liquidation preference of Series B, which is 30 million rupees. So you can go here.
So this is the assumption that till the time what he has invested, what was the value at the time of investment, he will not convert, or it's a stipulation for the conversion.
So as an investor, it doesn't make sense for you to convert until you get a payoff which is higher than the liquidation preference. Okay, so if you're getting 50 million as liquidation preference, you would want to convert wherein the proceeds after conversion is equal or greater than 15 million rupees. So what we are saying is, what is the threshold point wherein Series A investor would be break even between conversion or not converting. So when the value of the company is 80 million rupees, so let me take a simple waterfall here. So let's say we have got 80 million rupees. Now first value gets paid to Series B, which is 35 million, 30 million rupees. So remaining is is 50 million rupees. Now let's say Series A is converting. So common and Series A. So common has shares of 5 and Series A has a shares of 2.1. So we will allocate 50 million rupees among common and Series A based on number of shares which are held by them. Okay. So here is 7 rupees. So 50 million is allocated to 5 million and 2 million shares. So at this point of time, Series A basically gets 7 rupees per share for 2.1 million shares. So at when the value of the company is $80 million, Series A is indifferent between 15 million rupees as converted into common stock or receiving 50 million as liquidation preference. Hence, if the value of the company exceeds 80 million rupees, let's say it is exceeding to 90 million, then Series A will be better off converting to common stock. So we are determining what is the threshold point wherein Series A will opt to convert. So that is 80 million rupees. So if I go here, let's say floor and cap. So Series B will receive value when the value exceeds 0 rupees and up to 30 million rupees. A will receive the value when it exceeds 30 million rupees but up to 45 million rupees. Common stock will receive its value when it exceeds 45 million but up to 80 million. If the value of the company is higher than 80 million rupees, then A and common stock both will receive the value. Up to what point? Up to the point when Series B is converted to common stock. So Series B will convert to common stock when the value per share is 9 rupees 80 cents. 9 rupees 80 paisa. So that is computed as sum of all the shares, which is 10.2 million shares times 9.80. That will give you 200 million rupees. So sum of all the shares times 9.80. So up to the value of 100 million rupees, A and common stock both will receive the value. And if the value of the company is higher than 100 million rupees, that will be split equally among A, B, and C based on the number of shares which are held by them up to the point of exit value. Here I mentioned infinity because we don't know what the future exit value may look like. But anything which is more than 100 million would be distributed to A, B, and C based on the number of shares which is held by them. Now we need to also allocate the value. So,
Upasak, just one question.
yeah.
The preference share capital is the redeemable preference share capital. So, means if why we are deciding on the liquidating preference of value and everything, because
Redeemable is a different topic.
let's
Don't
say
take it here.
after 20 years at the time of redemption, the value is not that, but they still have the preference right of redemption. So they will take the whatever the principal value.
Mr. Pawan, redemption is a different topic. Please don't take it because participants would want to know about this example.
No.
Definitely
This is
this will get into
related to this only, Shilpa.
this is
I'm not.
option. No, redeemable is a different concept.
So
You will
Redeemable.
obstruct the flow.
Every
Please,
preference share is a redeemable preference share, Shilpa. Just
that's right. So I can respond quickly. It won't take more damage. So in that case, they will get 30 million rupees back. That's what the way we have done the waterfall is.
Okay.
The first 30 million proceeds gets paid to Series B, and if only if the value exceeds beyond the conversion value, which is 100 million, then only Series B will opt to convert.
Okay. That.
Sir, can you just please highlight the key differences between Series A and Series B in your illustration?
So the only difference is their seniority. Series B has a higher seniority versus Series A, and their valuation at which the investment was made. Series A came in at 50 million post money, and B came in at 100 million post money. So those are the only difference.
So any preference that Series B has over, any additional right that Series B investor has over Series A, like a tag or a drag, whatever, in your illustration. Strictly sticking to illustration, yes.
So here we are only considering economic rights. The other rights that you said are non-economic rights, like drag alone rights, veto rights. Okay?
Right.
Those are not non-economic rights, which we are not modeling as a part of option pricing methodology. We are strictly confining to economic rights.
I just have one more question. In real life also, does it always happen where the later investor will always want to exit early?
So it depends on how the negotiation has occurred. In most cases, a later investor will offer a higher seniority because they are investing in generally at a higher post-money valuation. But now if the company was not doing great and later investor came at a lower valuation, let's say 30 million rupees or 50 million rupees, then the earlier investor may negotiate a seniority which is equal to their round. So it's a pure dynamics of negotiation between the existing investors and the company and the new investors of that particular round. So this example assumes the company is doing good and progressing. Hence, the post money is a high, like almost 2x of the Series A, and hence they are negotiating a higher seniority.
Upasak, here you are mentioning that it's a CCPS, whereas the nature is of optionally convertible preference shares. So it's basically option is there with the investor that they, if they wish, they can get it converted. Otherwise, they will continue with the preference shares. So in that case, don't you think it should have been named as optionally convertible preference share in place of CCPS?
So it's one, and so it depends on again on how the documents are drafted. In some cases, they may write a CCPS because they may force to convert at a particular date on a particular event. In some cases, they may not put that clause, and hence it may be called as OCPS. But from the modeling perspective, we are indifferent because even in OCPS, the investor will convert if the payoff to them is higher upon conversion.
That is there. That I agree.
I would just like to add that in CCPS, they are always compulsorily convertible. Though if nothing happens, they will get compulsorily converted at the end of the term, which may be 20 years. They don't get redeemed ever, except in the case of liquidation, where they have a liquidation preference.
If they don't have liquidation preference, Joy, then
No. There is a liquidation preference anyway under Companies Act.
Okay.
So the point is that what is negotiated between the parties is the amount of liquidation preference.
So in our case,
and which series will get it in the preference.
So yeah, so let's not get into that discussion because that will vary on company to company. So what we are concerned is under this scenario, how the waterfall will work.
Upasak, only one question that because it is a liquidation preference and it will happen at future date or future event, do we need to discount it at the current rate also, means current present value also?
Not required because your option present method will already account for it.
Okay.
So
just one quick question. I know interest component is pretty low, but any interest component that is, you have to 0.01% or 1%, whatever number, that needs to get added somewhere if that is required.
Then we can add that into a liquidation preference. Currently, I assume no interest, but if there is an interest, then you can increase your liquidation preference by the accrued interest on the date of exit.
The only challenge what happens is interest. It depends on when you are calculating. Interest accumulation is only till that point of time. So every time we have to do that piece of work before we put up this Excel.
Yeah. So let's say I'm assuming a 3 years holding period. So I will take the interest for 3 years and add that to the liquidation preference.
Sure. Thank you.
Okay, so now moving here. So we get to this floor and cap. So between X to Y value, who gets paid what? So that is called allocation of value. So now first step is determine the incremental value. So in the first step, incremental value is 30 million rupees. Then between 30 to 45, that is a 15 million incremental value, and so on. So who gets this incremental value? So in first case, only series B will get because it is their liquidation preference. In next case, series A will get it is in its liquidation preference. In third case, common stock will get. In fourth case, both A and common stock are receiving the value between 80 to 100. Hence, that would be split between A and common stock based on number of shares which are held by them. So this 30% is the ownership percentage of Series A related to common stockholder. So 2 million divided by 7 million shares. So 20 million would be split like 30% to A and 70% to common stock. And if the value of the company exceeds $100 million, then that incremental value would be allocated to B, A, and common stock based on this proportion, which is again determined based on the number of shares which is held by them. That is 3 million divided by 10, approximately 10 million shares. So I'll take a pause here.
Allocation is based on incremental value. So it is not the overall value. The allocation is for the incremental value.
Yes, because you have already allocated 30 million. When you do a waterfall, so what happens? You will first pay 30 million rupees, and then the remaining 50 million gets paid to A stock.
Correct. Okay. Got it.
Any questions until this point, until row 16? How do we get to the strike price, floor, cap, allocation, or incremental value?
So if liquidation preference is not there, then what would be the value?
If it is not that, then you will just skip this breakpoint and directly start with this. But in most cases, you will have a
Okay.
liquidation preference.
Okay.
That's the underlying premise of a CCPS.
Okay.
So, short point, Upasak, in the case of the interest that is there, in the event it is non-cumulative, you would perhaps not take the non-cumulative portion, I guess.
Yes, that's right. We only take the cumulative and accruable interest.
Right.
So, any question on the calculation as such?
Can
Because
you
this,
once again please mention about that interest part, because normally interest is there.
so if the interest is cumulative and accruing, then you will add that cumulative accrued interest for the term of exit to your liquidation preference. So this 30 million rupees would increase by the cumulative interest which will accrue until a period of 3 years. So let's say if interest rate is 5% and it is compounding, so you take 5 into compounded for 3 years and add that to your liquidation preference. So let's make it simple. Liquidation preference is the amount which will be paid to the holder on an exit date if it doesn't choose to convert.
This we are doing for arriving at the strike price.
Yes, for the Black-Scholes model.
Okay.
So,
And there is no requirement to discount that because it is cumulative interest. It is not nothing to do with the discounting, correct?
yeah, no discount because your Black-Scholes model will account for the discounting stuff.
What is that RF 5%?
This is the risk-free rate.
Oh.
So what will happen if there is case of a IRR commitment, say 20% annual IRR commitment?
In that case, what will happen? Your conversion clause may change. So now, right now, I'm assuming 0% IRR. If there is 20% IRR, which needs to pay, then this liquidation preference may increase by that amount, and hence the conversion price may increase. So, for example, instead of 7 rupees, it may convert at 10 rupees. If there's a 50% IRR, let's hypothetically assume there's a 50% IRR to be paid for a life of 3 years. Then this price of 7 rupees at which it is issued will now increase to 10 rupees 50 paisa, wherein CZA will choose to convert. So in theory, let's get the theory straight so that everybody understands. A liquidation preference is the amount which will be paid to the holder if it decides not to convert, and it will only convert when the payoff upon conversion is greater than the liquidation preference. So that's a very simple logic we need to always apply. So depending on whatever the condition may be, we always keep that logic in mind that the investor will choose to convert if the payoff upon conversion is equal or greater than the liquidation preference.
Will
All
it
this
make any
exercise is
difference? Will it make any difference if the option is with the company to convert?
Generally, I have not seen that scenario because in most cases, investors will negotiate the right for them to convert, or they will put in a clause that conversion can be made by the company if certain conditions are met. So in most cases, they will protect themselves. Otherwise, there is no point of having a CCPS if there is no protection to the investor.
When there is variable.
Value.
So basically, in continuation to my last question, where IRR is there, so when I consider a IRR or probably whatever adjustment you are suggesting with respect to conversion ratio, so should I do when I will do a back solve normally, and when I do a back solve after having an impact of IRR, so we have seen that probably the value of the companies goes down. So is that adjustment is there, or probably you do certain other adjustment over there?
So if you have an IRR, so value of the company, you're doing a back solve on the issuance date. Am I right?
No. Okay. So for example, my reporting date is say 1 year after the issuance date. So for issuance dates, for sure, we will not use this. However, for say probably from 1 year from issuance date is my reporting date, and when I'm doing the back solve, and probably I have to consider say 20% IRR on that date. So basically 20% accrued to the preferred holders. So how to consider that?
So you will increase the liquidation preference by 20% IRR. And then remaining calculation would be similar, but just the numbers will change. So instead of 30 million, you will have 36 million as liquidation preference, which means the payoff to the investors on a per share would be 36 million rupees divided by 3 million, close to 11.8, let's say 7 rupees per share, at which it will convert to common stock. So the construct will remain same. So I think the purpose of today's call is to help you with the construct. And once the construct is clear, you can always change the input that goes in the construct. So for example, you can always play with the liquidation preference based on the terms conditions, and then you accordingly determine the price at which it will convert. But I think knowing the construct about how do you get to the strike price, how do you allocate the value is more critical for this discussion today. So let's focus on this part because I think that's what most of the participants have requested. So I'll continue with the calculation part and then we can take up the theory part.
Upasak, one question, like, which is
1 minute,
taking,
Manish. 1 minute.
yeah.
Upasak, considering the time is 9, would you like to take a break for 10 minutes? It's up to you. I leave that.
So let's first, what we can do, let's first complete this example, okay, in next 15 minutes, and then before the case study, we can take a break.
Yeah, it's up to you. Okay.
So I'll just continue where I left here. So we get to the strike price, floor and cap. So floor and cap is nothing but beginning value and the high upper limit. Then was incremental value. Who gets this incremental value? This is called allocation of value. So until this point is very critical. Now we come to the, so until this point you don't do any black swatch work, but now you basically apply the option pricing method. So we have 5 options here. B receiving LP, A receiving LP, common stock receiving value, A converting and B converting. So we will do we'll do 5 call options on the company. So in call option there are 5 variables. So the first variable is the stock price. Other 3 variables are here, and the 5th variable is the strike price. So what I am saying is that the investor would get the money if the value is higher than 0, greater than 0, but equal or below 30 million rupees. So I'm buying a call option with a 0 value as my strike price and selling the call option at 30 million rupees. So the value of call option at flow is 125 and at the cap is 99 million. We repeat the same exercise for all the break strike prices. So we get floor call option value and cap call option value. Now, how to get to call option value? I will share this Excel in which you have the formulas. No need to memorize the formula or get in detail. This is more statistical in nature and it is universally accepted. So I will not debate on that part. How does this determine? But this is the way we do a call option in the Black-Scholes model. So as I showed earlier here, difference between this and this or between floor and cap is paid to B. So we do the same exercise here. The difference between floor call option and cap call option gets paid to B under first scenario, and then gets this difference gets paid to A, and then common stock, and then it is split between A and common stock for fourth, and then incremental value gets paid to B, A, and C in the last break point. So this all is very straightforward in nature. So what you need to understand how to get to the location, which was discussed here, how to get to the strike prices. If you are aware about these 2 components, then remaining is pretty simple because you just have to compute the difference between floor and the cap and allocate the difference to the respective holders based on the underlying breakpoint, underlying scenario. So in this case, we are saying the ratio is 30 to 70. That is 9 million times 30, 9 million times 70. You sum the values across all the 5 options. And then you basically divide this by number of shares which are issued to the CCPS holders to get the per share value. Okay, Roshan has a question on floor and the cap option value and the differences. So let me take this example here. So what we are saying, from 0 to 30 million rupees, only B gets the value. So if we were doing a waterfall as on the exit date, then what we would have done is we would have basically known what is the value of the company on a future exit date. let's say we know the value of the company is 150 million rupees on the future exit date. So first gets paid to what? So in this case, we know that. So let's take a smaller number to make it easy. So first you pay to Series B, and then you have remaining value. Now you need to figure out the allocation of 60 million rupees. Now if I pay LP to Series A, I'm just doing a hypothetical example. If I do pay LP to Series A, then common stock would get 45 million rupees, which may not be right. Hence, I will say no LP to Series A, and then you split between common and Series A. So, in theory, if we know the future value of the company on a future exit day, we can do a simple waterfall and then discount it. But since we don't know the future value of the company on a future exit date, it can be any number. Similar to a stock price of the company, when we buy a call option on a company's stock, let's say you're buying a call option on Reliance Industries, which is currently trading at 2200 rupees, and buying call option for 2500 rupees. That means you don't know what the future value of the company or stock, which is Reliance stock, may be in the future date. Hence, we are buying a call option today, and the payoff would be determined based on what the value may look like. But for today, your payoff is based on the call option premium which you will be paying. In this case, it is out of the money, so it won't be very high. But the idea is to figure out how do you relate the call option to the company's equity value. So instead of a stock, these CCPS holders have a call option on the company's equity value. So up to the value of 30 million rupees, Series B will have the right. And then between 30 to 45, A has the right, and so on. So what we are converting this strike prices into call option values. So at zero, what is the call option value? Obviously, it will be the equity value of the company, because zero strike price means 100% value is the call option value. At 30 million strike price, the call option value is 99 million rupees. So difference between these two is allocable to Series B stockholders. That is the premise of the option pricing methodology. Now there was a question here. Wouldn't the exit dates be different for different series? No, the exit date is of the company when the company will either go public or get acquired or liquidate. So in the agreement, there either exists at IPO or buyback at a company. So that will be considered as a calculation of term. So the agreement would say 5 years or the buyback or the COC. So what you can model in different exit dates. Let's say you have 3 scenarios. You may have an IPO, a COC, or let's say dissolution.
So, Upasak, in the case of an IRR, if the covenant is that the IRR will be paid at the rate of, let's say, 15% from second year onwards, then on the issue price, would you basically average out the IRR, or you would not treat it as there for the first year on the issue date?
What I would do is I would compute the expected IRR until the exit date and then add that IRR to the liquidation preference.
Yeah, so basically that would mean that if, for example, there's no IRR for the first year, then for the second and the third year, you would then average it out over the 3 years. Is that right?
Yes, or you can just compute the IRR for each year and then add the gross value to the liquidation preference. Because liquidation preference is the value of the security which it would receive if it is not converting into common stock on the exit date. So that's the term rule.
Can you elaborate the term, please, then?
So liquidation preference is the value which
term,
is paid.
Term.
Term.
Sorry.
Okay, yeah, term. So let's say you have these 3 dates. For example, this is 2 years. Let's say this is 3 years, and this is, let's say, 1 year.
आगे हैं थोड़े
And then
आज
let's
तो
say
इतनी
you
लड़ाइयाँ हो
you
गई
have
हैं
got, let's say, 50% probability.
सबको
that
कोड
you
बांट
get.
दिया उसने लेट हो गए लोग 15 मिनट लेट
Okay, so now I would say
इसका दोस्त है
COC is what is COC,
sorry,
Upasak?
it is merger or acquisition. So change of
अरे
control.
भाई कोड लेट कर दिया सबके इसने किसी को एकोमोडेट करने के लिए सबके आधे आधे घंटे लेट
Pavanji, can you please mute yourself?
ओ सॉरी
Are you?
So your weighted average term is 2 years in this case. So 2 times 50, 3 times 25, 1 times 25. So in this case, you will take a term of 2 years. We won't be doing like separate option pricing models for each scenario, but we can take a weighted average term.
That helps. Thank you.
Okay. So
Resolution term is taken as 1 year. That should be longer one.
So this is just a hypothetical example. This will depend on company to company.
That is definitely there, but in case of any agreement, resolution would normally be considered at the last issue. So it should be normally more than the other two alternates. That's it. That is my thinking.
Yeah, that's right. But what happens sometimes if the company is in dire needs of fund, okay, and if they don't receive the fund the next 1 year, they may have to dissolve. This scenario assumes that company would have raised more money in the next 1 year, and then they can go public or get acquired. So there is no rule that it should be higher or lower than the actual M&A term. It completely depends on the underlying company and the scenario in which it is operating. If the company just raised funds, let's say they have raised 30 million rupees, then they may have runway for next 4 years. So in that case, you may take a 4-year term, which is completely up to the appraiser to determine what are likely possible exits and the timeline for that exit and the probability for that exits. This is a subjective input which varies from company to company.
And this term will vary every time, every year when you are reporting.
Yes, depending on underlying economic environment, company's performance on that particular date.
Upasak, I have one question. This row 21 stock price, 125 million, and which is there on 32. What is it exactly? I mean, how do you describe that?
So this is the value of the company as of the valuation date.
So this will be the reporting date period then we are talking
Yes.
about?
Yes.
Okay.
Okay.
So if that will be provided by whom?
That has to be determined by the appraiser using a DCF or a market approach.
Okay, so that needs to be first fair valuation needs to be done for the company value, then further.
Yes.
This is the pre-money value of the company?
Not a pre-money. Not necessary, because this is the value of the company. Pre-money can be higher or below it. So pre-money is basically based on the negotiation between the investor and the company. But this is an unbiased value determined by the appraiser based on the certain set of projections provided by the company and market environment and so on.
So, Upasak, in case of a listed company, this would be my market cap. I mean,
Yes, definitely.
Right.
Definitely.
Fine.
But one question here, when you are doing this company value, fair value, the unlisted entity, what will be the status of this CCPS A and B? Will they be debt only?
So again, I'm not an expert in that on how do you report it, but I think this is
No, I'm not talking about reporting. From the value of the, since 125 is the equity value, right? That's how it starts. So for calculating equity value, we use various methods and so subtract all the debt to determine the equity value. So the debt.
So we won't subtract them to get to the equity value. So what we will assume that 125 million is before the subtraction of CCPS value, because we are using this to determine value of CCPS. So we are assuming CCPS. So 125 million is after subtraction of only secured debt and other liabilities, but not we won't deduct the CCPS value from $125 million.
To add to what Upasak is saying, I think 125 million is the fair value. So that's fair value will be given by the company. So
No, it has to be derived.
Including
Derived. How can
CCPS.
company give it?
Derived,
Fair value.
derived.
CCPS.
Upasak, how does then the ESOP shareholders would get paid if there is, say, hypothetically 5% is held by the stock ESOP holders?
This is a very good question. So, in that case, ESOP would have a strike price. Okay, there a certain price at which the shares will be issued to the ESOP holders. So in that case, it will be very similar to a CCPS without the liquidation preference. For example, let's add a row here. ESOP, let's say, have a price of 3 rupees per share. Then ESOP will get paid when the value of common stock is equivalent to 3 rupees per share. So you will add one more breakpoint over here, in which you is right ESOP gets paid.
Normally, the ESOP needs to be added to the common stock or not?
No, because ESOP will have a strike price, and common stock won't have a strike price. So common stock will be paid after the liquidation preference is paid to the CCPS holders, but ESOP will be paid only after a point wherein the value of a common stock is higher than the strike price of the ESOP holders. ESOP won't be issued at a zero strike price. It will have a certain strike price associated with it.
It might be possible the ESOP is given to the employee free of cost.
In that case, you can add that to the common stock.
So
yeah, but ESOP is not existing, or rather the shares are not existing on the valuation date. You know, for ESOP holders, they are just holding an option. So should we consider this at all in the valuation?
We should, because it is a future claim on the company's equity. And if the ESOPs are vested, then they will definitely held shares. And
yeah, vested maybe, yeah, but unvested ones.
So we have to figure out how many ESOPs would be vested before end of the term. So we have a term of 3 years. And if the ESOP clause suggests that upon an IPO or an M&A, all unvested ESOP would be vested, then you should consider that as a part of your capital structure.
Upasak, would you be able to share one model considering ESOP? Because ESOP will be fairly, any Series A funded company would have a ESOP as a standard structure.
Yes, so what I can do, it won't take more than 5 minutes. I can just show you right now. So let's say you have an ESOP with 1 million shares. Okay, at the price of 3 rupees per share.
You are assuming that the ESOP holder and the term of the ESOP issuance is at the price of 3 rupees. If the price is more than 3 rupees at the time of the exercise date, then they will opt for the ESOP. Otherwise, they will not opt.
That's right.
On behalf of all the members, I suggest, in case you have done this exercise for any listed company, which is publicly available in the public domain, so any such valuation report can you share, which you have?
I don't think we have done it for a public company, because for public company it is not that difficult since it is a markedly traded security.
But sometimes it is attached to MGT 14 by the company secretary who would have filed MGT 14, no?
Yes, I can check and I'll let you know.
Anything which has a similar, but will you be capturing all of this in that report? At least half of this Excel?
Not, we won't be showing any calculations in the report. The report will only have the numbers like a PDF report and not the Excel workbook. So it won't be as useful to the reader, because it won't show how the calculation is determined.
But still it will be beneficial.
Just to take this point forward, typically from a reporting point of view, you will capture in the premise of the report the market value method, because it has a combination of a Black-Scholes, which is like an income method, and then Black-Scholes, which is an income method, and then we are looking at a Black-Scholes model or option pricing model, which is more of a market value.
So Black-Scholes itself is an option pricing method. The option pricing method has 3 approaches: Black-Scholes, binary analytics, and Monte Carlo simulation.
Correct. But this, when you're using that as a reference point, which is a fair value of the company, which is last traded price, and then calculating it backwards, more to come from a, so then you also use a like a last transaction value, like a market value method there.
I didn't understand the question. I just explain it again.
No, I'm saying the way, please correct my understanding. We are using two methods here, right? One is the income approach method when we say that we are using a Black and Scholes, right? And when we take a fair value to do the valuation of the company, the valuation we are using a last transaction value, right?
So I don't. So we won't determine that Black scores is an income or a market approach. It's an option. It's a different than income and market approach. It's a basically allocation approach. So there
From
are
a in days, I mean, so from our valuation, RVO valuation reporting structure point of view, we had to mention an approach right there.
yes, but that is purely for the value of the company. But here we are doing allocation of the value. So we can call it as an allocation approach, and option by the manager is like an approved allocation approach for allocating the value among different classes of securities.
Okay.
Just try to forward us the report which is publicly available, no? As a part of public documents or something. If you can
Sure.
share
Yeah.
the name of company also, we can download on our own.
Yes.
So,
Let me check that. I'll get back to you.
So Upasak, in ESOP, we typically have a pool. So let's say that we have a pool of 10%, out of which, I mean, the company at a particular stage when we are doing the valuation would have disbursed 5%. Balance 5% is still available, or maybe we have disbursed 8%, 2% is still available. Here, when we are evaluating, do we take 10% or do we take 8%, which is disbursed?
So in this case, we are referring to the ESOP pool of 8%.
Yeah. So if typically a company has a ESOP pool of 10%, correct?
Correct.
Correct. And out of that, they do it over a period of time, correct? When the employee joins, they give the stock options, correct?
That's
So
right.
let's say that at this particular point of time, when on the reporting date we are evaluating, 8% of the pool has been disbursed.
Correct.
Which means they have been granted. Okay.
Yes.
The balance 2% is yet to be granted. Now, when we are doing this calculation, do we take 8% of the pool for ESOP purposes? Because you're talking about the number of shares as 1 million, correct? Is that 1 million 10% or is that 8%? Yeah.
Okay, I can respond to this question. So again, it depends on the appraiser. So in some cases, we may take 8% if we don't have the clarity about when the remaining 2% would be granted to the employees. However, if the management would inform that we anticipate to grant the remaining 2% before the term end of term, which is 3 years. In that case, we may take the entire 10% because we know that before potential exit may take place, the entire 10% will be granted and outstanding. And so it's better to consider the entire option pool. But if we don't have that information, or if the grant is expected to occur after the end of term, in that case, we may not take those options as a part of the cap structure.
Upasak, if they have granted on the valuation date, won't my common stock increase to that extent?
Yes, that's what we are showing here. You won't, unless they are granted at a zero price, you won't add them into common stock.
Right.
We should them as a separate line item on a cap structure.
So this is
in case of ESOP, the seniority will be 3 or 4. That I think that should be 3 because they have got issue price is more than the common stock price.
So in that case, so ESOP is very similar to common stock. So both gets paid in parallel, but the only difference is the strike price. Hence, you can call it as a fourth seniority for the secure presentation, but you won't find that in any agreements. In agreements, you only find the seniority for B and A, and that after that it will be mentioned that the remaining percentage will be paid to common stock or stock option holders.
So it will be common to both of them at 3.
Sir, can you? It will be common. Yes. It doesn't matter. Yeah, it doesn't matter a lot because you will have multiple ESOPs. So you can call it as a third or fourth. It doesn't matter as in that sense because ESOPs will be paid only after you pay A and B.
No, after A and B, my question is only after the A and B only. When before common stock or before, along with the common stock?
You would be paid after the common stock gets a value which is equivalent to the strike price of the ESOP holders.
See, ESOPs anyway don't become shares until they are exercised.
Yes.
Right. Yeah. And then when they are exercised, they get converted into common stock. So they are equal to the common stock, but the employee, the holder will not convert it till the value that he is getting is more or equal to the strike price.
That's right.
So here an event gets created when it exceeds 3 rupees, correct? So that's an event wherein ESOP gets converted to stock. So the pool
That's
of
right.
stock increases. Okay, that's what
Yes.
you are evaluating.
Yes. So I'm just adding a breakpoint to figure out when the ESOP gets paid. So it will be paid when the value of the company is equal to 63 million rupees. So now up till that, up to 63 million, ESOP won't get any money. But after, as soon as it crosses 63 million rupees, ESOP will get some payoff. So now between 60 to 80 common stock as well as ESOP will get paid. So we'll figure out the allocation ratio for common stock and ESOP.
Upasak, this participating is our basic assumption about that these shares are participating in nature or
Non-participating in nature.
Okay.
In Indian context, most of the stocks, CCPs are non-participating, hence I was non-participating. But if you're running a company for US, then it may depend on investment, preferred shares to preferred shares.
See, in the case of CCPS, it doesn't matter whether they are participating or not because the shareholder can convert them at any point in time.
Yeah, so I think the question was if it is a participating share, then it will receive both the liquidation preference and the value along with the common stock. But in the context of CCPS, we don't
It
generally.
doesn't matter na, because they will only convert if it is higher than liquidation preference.
Yes, but
And get a higher value. Huh.
That's right. But in the context of fully participating means they don't have to convert. They will receive both the liquidation preference and the value of common stock along with the common stock. So,
yeah.
But for the purpose of this exercise, in India, CCPS doesn't have participation rights. We are not considering that as a part of this exercise. So I'll just refresh on this. So we added a new line item called ESOP with a strike price of 3 rupees per share or per option. Okay, and 1 million options are outstanding or expected to be outstanding on the exit date. So we've computed what will be the strike price of the company wherein the ESOP holders would exercise, which is computed as sum of the liquidation preferences for A and B plus 3 rupees paid to the common stockholders. So 3 times 5 is 15 million rupees plus LP, which is 45 million rupees. So you get a value of 63 million rupees when the ESOP would be paid or would be in the money, and then so this is how the strike price would be determined, and then the same concept.
Can you explain the 63 part again, just to reaffirm?
So, what will be the value of the company when the ESOP will be in the money?
Correct.
It is. It means that.
Got you.
So basically the logic says you need to first pay the LP, which is $45 million, plus you have 6 million worth of common stock plus ESOPs times 3 rupees. Hence 63 million rupees is the point after which ESOP will be in the money. Then since we added a breakpoint, we have to add one more breakpoint over here.
Can you explain 87 million? That, yeah, in that.
So now
63, I got it.
Yeah,
Then
60. But now A needs to convert to common stock. So ESOP and common stock should also receive 7 rupees per share. So what we are saying is that everybody A common stock and ESOP receives 7 rupees per share. So number of shares into 7 plus liquidation preference of series B because they will not convert yet. So that will get us to 87 million rupees.
Okay.
Since now
Got
we added a breakpoint, we need to also add the same in the allocation part.
Maybe in E16 and E17, you'll have to write the ESOP, Series A plus common stock shares plus ESOP.
how you get the cap of call option 99,798?
Which one?
The cap on call option 99,798,652. In the first case, 30 billion in this
Row
option.
number 32, I think.
Upasak, can you do one thing? Can you finalize your workings and then share it on the chat? I mean, because this is too much for the viewers to, incorporate for the Excel workings.
Yes.
Cap call option.
Just a second. Let me just complete.
Yeah, complete it and then share the revised Excel with us. Thank you.
What is our purpose over here is we are calculating the CCPS value or issue price is already given. So we are calculating CCPS value.
Yes, fair value of CCPS as on the reporting date.
As on the reporting date. So,
yeah.
So the reporting date, you are calculating the value of 13 rupees, 15 rupees, 10 rupees, like this way?
Yes, that's right. So you may also report on an aggregate basis if required or on a per share basis.
On per share, yeah, per share basis means 13 rupees if the value came. So means 13 rupees for series B and 15 rupees for series A.
Yes, that's right.
That way, so there will be a difference in the value of each CCPS.
Yes,
the
because,
same
because they came at a different valuation point.
Yes. So on the reporting date, but the value will be same, na?
On the reporting date, no, because they came at the different issue prices, hence the payoff to them would be different in nature.
Okay.
If we are valuing CCPS, then this common stock and ESOP valuation would be relevant because for the purpose of reporting?
Sorry, can you go if we are valuing?
Series A, Series B, CCPS, and we are also valuing common stock and this ESOP stock.
Okay.
So for the purpose of reporting, we just need to see the CCPS, or is there any relevance for common stock value? And
you can obviously consider the value of common stock from this analysis because we are considering common stock. However, the value of ESOP, you may have to do a different exercise which Dhara told yesterday, wherein you take the value of common stock as a stock price and then you take the term of the ESOP for the life of the ESOP and then do a separate black scores to get the value of the ESOP because this assumes a term which is relevant for the company, but for the ESOP holders, the term is required as an average of the vesting period and the expiration date.
for the purpose of Black-Scholes, the value per share would be 10.99 value of the company?
Yes, for the value of the common stock. That's right.
Series A cannot be higher than Series B, right? Because Series B rights are higher.
It can be. The reason is because they get more number of shares. So upon a conversion, the payoff to Series A would be much higher than Series B. So, but just let me finalize the calculation quickly just to understand that the math is right.
Starting point of this calculation is that 125 million rupees
Is that the DCF valuation of the company?
Yes, that's right. DCF or any approach that you may consider.
Okay, and this DCF is calculated assuming that Series A will come in, basically that the 5 million rupees is the requirement of the company. Funding requirement will be met 50 million, sorry.
You are referring to which data, 50 or 15?
I'm talking, oh sorry, 15. So 15 million will be funded, and that is why I'm able to come at 125 million of value.
No, so this was already funded on a historical date, and this is as of the reporting date.
Okay, but if I'm valuing it at a start point, or when I'm issuing the CCPS, at that point of time, if I'm starting with the DCF of the company, at that stage, do I assume that the investor will come in with the money and then I'm meeting those projections?
But so what I'm saying, this investment already occurred historically in the company.
Correct.
So this investment would have taken place in, let's say, 2018 or 2019, and you're valuing as of 2021. So for a purpose to receive this investment is already been made in the company. So you don't have to now assume that it will cover. It's already received by the company. But what you are referring to is the future financing, which we are not modeling as a part of option pricing model. Let's say what money the company may require to raise in order to get to a successful exit. That we are not modeling right now as a part of our option pricing matter. Option pricing matter assumes the cap structure which is outstanding as of the valuation date.
Okay. And what if I was issuing a CCPS today and not valuing it at a reporting date? In that case, what would be my starting point? The DCF assuming funding is coming in, or DCF assuming the operations are as a going concern as it is?
So since we already know CCP has been issued as of the issuance date, we will assume that the money has come in, and you had the required cash to fund your expansion plan or the cash flow, and accordingly you will determine the value in the DCF.
Understood. Thank you.
So in that case, the value which we are I'm driving the stock price on the reporting date will be the post money, because money have already came in
on the reporting date. So you don't determine now post and pre money on the reporting date, because now you're only concerned with the
value of the company.
That's right.
True.
Sir, just one question. Sometimes in higher series round, for example, in series B, majorly CCPSs are issued, but there are some equity shares are also issued. So will that have a higher seniority than series A, or will they be treated as like common stock only? In this scenario, will they be clubbed into common stock?
Yeah, if you're issuing common stock, it will be clubbed into common stock.
But they are issued at a higher price.
Then also. Because you don't have the CCPS would have the underlying rights in which they would be paid liquidation preference, or it will convert to common equity upon a future date. But if you don't have that right, that means you are only a common stock and you don't have any claim on the company's asset in the form of liquidation preference.
So Upasak, in this case, the value of the option is 13 rupees minus 10 rupees. And the value of the option in case of CCPS Series B is 13 rupees minus 10 rupees 55 paisa, or 13 rupees itself.
13 rupees. Okay, so CCPS value is 13 rupees. Now you're referring to 10 rupees.
That is the equity value, 10.55 that you arrived at.
So again, now that's what you might, if you want to split this between debt and equity,
yes,
then you can call 10 rupees as equity and 2.50 paisa as your debt.
No, but what is the final use of these values is what I'm asking. So subsequently, we will have to split the equity and the liability and then disclose. That is the objective, right?
So it depends on the financial reporting requirement for underlying. So if you need to split, you can obviously split this into debt and equity. So your
equity would be 10.55 and debt would be 2.65.
Yes, and some cases, even if you want to report, you can also mention that your debt can be 25 million rupees, because this is paid as a liquidation preference, and 14 million is a part of a equity allocation. So you can call this as equity portion, this as a debt, 25 million as debt portion, and 40 million as equity portion. But again, I'm not very much familiar with all the regulation around it. So you may also call 10.5 as equity based on common stock. CCPS converts to one common stock for one share, and the delta can be called as delta of 13 and 10.55 may be called as the debt portion. But now this will access this through this access you have the necessary data points for reporting purposes.
Can you also write the steps, what we need to do first, second, third, fourth, fifth?
Yeah, so
Because,
I mentioned
the
that in
model
the
is complex and we just need to be the stepwise thing.
yes. So what
It's
I've
not every,
I've presented a case study here, which I'll just quickly show you, and then we can take a 10 minutes break. So uh, and in the PowerPoint presentation, I've given all mentioned all the steps which will help you understand that.
Just want to understand cap of call options. Cap of call options. How you got it?
This one?
No. Down.
Okay, this one.
This 99. Yes.
Okay. So basically,
this sheet you please explain fully the floor cap and everything.
Yeah.
From
So
22 to
okay,
30.
so floor strike price. Okay, so now this we have computed here. That means what is the minimum value at which you will the investor will start receiving the value. Let's start with, let's say for example, Series A. Series A will receive the value when the total value of the company is higher than 30 million rupees. So that becomes the floor price. Floor is basically the bottom price after which you will get your payoff. And the cap price means up to what value of the company you will get the payoff. So
Yes.
A will receive the value when it is more than 30 million rupees, but equal to or less than 45 million rupees. Hence, we are terming it as a floor or a cap. So these are not any like legal terms. These are just for the explanation.
But I understood 25 and 26. Explain me 31 and 32.
So now in the black squares, if you are doing a call option, you have all the 5 variable inputs. So what we are doing is that, okay, what is the value of the call option using a floor strike price and value of the call option using the cap strike price. So we are doing two separate call options, one using floor and one using cap. Okay, so it's pretty much straightforward. So yesterday Dhara explained how do you value the call option. We do the same exercise, but now we have two strike prices. So we have two value of call option, one for floor and one for cap.
Upasak, I think because of paucity of time, we couldn't exactly understand this particular Black-Scholes model, this particular cell what we are. I think
So
because of paucity of time,
I think if you
okay,
increase
I can
the
explain you. I can explain you. It won't take long. So this is the Black-Scholes formula. Okay, in which we use a 5 variable inputs. Your stock price, your risk-free rate, term volatility, and your strike price. So this in this formula we are taking the stock price, which is 125 million rupees, times normal distribution of D1 less a normal distribution of D2 and present value of the strike price. So 0 is the strike price, present value using RF and term. Okay, times normal distribution of D2. Now D1 and D2 are computed here. This D1, D2, and call option are based on the Black-Scholes formula, which is published in any material. We won't be taking a deep dive into the statistics behind Black-Scholes because even I am not a statistician, so I cannot explain you very fairly what is D1, D2, and call option construct. But this is a universally accepted formula on how to get to a value of a call option using a Black-Scholes formula. So the only thing that we are concerned is the key inputs, which is your stock price, strike price, and the three variable RF, term, and volatility. So we are saying that okay, if my strike price is 0, then what is the value of call option? Which is 125 million rupees. If my strike price is 30 million rupees, what is the value of my call option? 99 million rupees. So I am computing the call option at 30 million rupees, and here also I'm doing the same thing. So I'm saying, okay, what's the value of my call option at 0 strike price and value of my call option at 30 million strike price. So I compute the call option value for both the strike prices because my payoff to B is between these two data points, between 0 and 30 million rupees. So basically, if by investing in the series B, I own a call option with a 0 strike price, but I am selling a call option 30 million rupees because I will leave my claim on the company when it exceeds 30 million rupees. So delta between the both strike prices is the value of my investment as of today. Okay, so, and we do the similar exercise for across all the strike prices, or all the, you may call it breakpoint strike prices, where you want to call it, but we determine the call option differences for each scenario, and delta between the two or difference between the two is allocated to the securities for that particular point. So I've labeled 1, 2, 3, 4, 5, 6, which is the same thing over here. So you can, when you read this Excel, basically you can do it this way. So your first breakpoint suggests series B gets its LP. Your breakpoint 2 suggests A gets its LP. So hence you have accordingly floor and cap and so on. And the delta between the two gets allocated to A, in this case B, in this case common stock, in this case common stock and ESOP, in this case to A common stock and ESOPs, in this case to every shareholder. So we compute the delta. In the last breakpoint, since we don't know what the future value may be, so we call it, we don't define it because it is unlimited. It can be anywhere. It can be 200 million, can be 500 million, can be $1 billion, billion rupees. We don't know. So we don't put a number to that. But we say any value that exceeds 109 million is distributed to all the classes of securities according to the ownership percentage. So we determine that percentages and then allocate this difference of call option based on these percentages to each security share or security holders, and then you basically get to the per security value, and in all the cases your total value would be equivalent to the stock price. So this exercise is basically determining that $125 million value of the rupees of the company, how this is allocated to different classes of securities based on the rights and preferences. If company only had common stock, then you would simply take 195 million rupees divided by number of common stock shares. But in this case, company has different classes of securities, B, A, common stock, and ESOPs. So how do you determine it? You cannot do a simple plain vanilla exercise because they have a future claim on the company, and the exit may take place in the future. Hence, to model the uncertainty, we do an option pricing model.
Upasak, okay, we have understood that one usage of this is India's requirement. And suppose at this date, I am issuing a new CCPS Series C. What price I have to use?
Okay, if you're issuing a new CCPS,
Series C now, for which I have arrived 125 million as a company's valuation.
in that case, we can do a simple plain vanilla waterfall, or you can be, there's an approach called a backsolve method, wherein we basically backsolve such a way that the value of the company is 1 million rupees, and accordingly figure out the value of Series C CCPS. In most cases, you would company would have negotiated the this ownership percentage which the CCPS holders will get upon a conversion event. We would know that scenario. Hence, we would note these values on the investment date. So, as on the investment date, the value of CCPS would already be determined by the investor and the company. And as an appraiser, we will have to figure out what is the fair value. So in that case, we can do a backsolve method such a way that what will be my implied equity values so that the value of Series B CCPS is 980. So for example, currently by using the same set of assumptions, I am getting a value of Series B at 13 rupees. But if I'm valuing the security as on the issuance date, then what I will do is I will run basically okay. So my fair value of CCPS should be equivalent to the issue price. So what will be the implied equity value of the company? So what I'm saying that my implied equity value of the company is 78 million rupees. Wherein the value of my Series B CCPS is equivalent to its issue price. That is one way. Another way is doing a simple waterfall, wherein we don't do an option budget method, but we directly take, okay, I'm determining value of the company as 100 million post money. I do a simple waterfall in order to compute the value of CCPS. So it depends on the underlying scenario and the terms of the CCPS investment.
Okay.
Upasak, can we do for a fresh issuance of Series C, first we would need to know the terms, right? Now, in this case, in the question, I think the terms are not clear. So if we, even if we assume that Series B and Series C have the same terms, then for a fresh Series C valuation, I would need to calculate the option valuation for the Series C separately, right? And I would need to add that option premium to the equity share value to arrive at the Series C fair valuation of the CCPS, right?
So in most
Or
in most cases, you would be aware. So when a CCPS investment takes place, it will take as a fair value. So we will assume that the price which is negotiated between the investor and the company is a fair value.
Right.
Now, as an appraiser, you have to basically produce a report which suppose that the fair value makes sense or not. In other words, we are basically doing a back calculation because we know the we know the answer. We build out a structure to support that answer. Okay.
Right.
In that case, we may not do this option model, or we may do an option budget method and do a backstall analysis to figure out what's the implied equity value of the company, such that the fair value of Series C CCPS is equal to its negotiated price.
No, fair enough, but that is the numerator, so to speak. But when I'm talking about price per share, then in that case, how would we arrive at that value? I mean, if we're talking about a fresh issuance of Series C, CCPS, in your same example, with the Series C being seniority 1, right? And let's say Series C round is, let's say, at 50 million, right? And there is a fresh issuance. And I know with the valuers are approached to fair value the fresh issuance as per the Companies Act regulations, which is primarily the case for registered valuers.
Yes.
So I think her question was fresh issuance of a CCPS of a Series C in the same scenario. How will it the valuation be like?
In a fresh issuance, you would also know what's the company's value for CCPS conversion. Because they would have negotiated that price. They won't just give you the term that, okay, I'm investing 50 million rupees in the company, but we have not negotiated on the conversion value of the company, or the value at which the CCPS will convert to common stock. That would be also be negotiated. So as an appraiser, you will have the information that, okay, what was the price negotiated between the investor and the company.
No, that is fine. See, in some cases, agreements I have also come across that the price, the total investment amount is agreed upon, right? But the price per share, so to speak, is not, sort of agreed upon. So in that case, let's say that is the case. So in that case, how to approach the valuation?
In that case, we do a similar exercise in which you do your DCF approach, determine the value of the company.
Right.
Okay. And then based on that, you can do a simple waterfall and not do an option pricing method. As when you do a simple waterfall, you basically say, okay, or you pay off to your CCBA, CCPS, convert them. But
No,
even in your
but a simple DCI would give me an equity value, right? But I want to arrive at the value of a CCPS.
But in even if you
Including
have
CCPS.
if you have received a term sheet in which you have within which it is mentioned that how much amount of investment would take place, you also mention what ownership of the company that CCPS holders will receive or how many shares it will receive. Without that,
No.
the term sheet will be incomplete because that in that case becomes just a debt because they have to determine how many shares or percentage of the company they will get upon this investment.
No, so let's say the assignment is to determine the number of shares.
Can I ask a question here? Because definitely we are confused. Pranav's question, I think Pranav, I'll rephrase it and I just try to understand. They are saying that there's a company where they want to issue a fresh CCPS.
Right.
That's what they're saying. Now, the principle here is if the company is fair, first you ascertain the fair value of the company to all the existing holders, whether it is CCPS or equity. So there's a
Correct.
fair value that you got it, right?
Right.
Now, if at the same fair value, you are raising further capital. So the fair value is your pre-money. Whatever capital you're raising will add up to the post-money.
Right.
Now, therefore, that money that you are adding it, because your fair value is the basis of your investor, the pre-money valuation will be the value of the CCPS also that you are incrementally investing. Unless what he stated is that incremental money that is coming in is coming with certain economic rights.
Right.
If it is coming with certain economic rights, while you do the post-money valuation, apply these economic rights and you see, and invariably because you have applied this economic rights of liquidation preference, the new Series C investor would have come at a better price than the fair market value.
Right. So that's what I'm trying. The point I'm trying to make here is that if I'm issuing a fresh Series C CCPS, the value of the CCPS, because the deals are structured in a way where 99% is CCPS and one equity share is offered, right?
Agree.
And so in that case, the fair value of the CCPS and the equity will be different. That's what I'm trying to say.
See, I think somewhere fair value of equity is nothing but the fair value of the company before you issue shares, right? It's a pre-money valuation, the company valuation. The fresh investment that you're seeking in, whether in the form of the debt instrument, because equity is equity. Suppose if you have got a premium for the equity, that premium is very much there.
Yeah,
Once you bring in the CCPS money, now if you apply this economic rights into that and the effective value of that particular share, which is what he has shown as issue price, if it is same as the per share value of the pre-money, then the incremental CCPS that has come there, it has come at the fair value.
So see, there are two things. The incremental CCPS is also coming and incremental equity, common stock is also coming. So if I have to value both and the transaction is one, so in that case, I cannot treat my equity at par with CCPS. Both have different rights altogether. That's what I'm trying to say.
So okay, you apply the same thing here instead of Series C, after right Series C, CCPS and common stock. And say in the same method what he has shown here, in the common stock, your common stock will go away and your Series C CPS will stand there and calculate the issue price based on that. And if the issue price that you get it is equal to the fair market value, then it has been issued at fair value. If the issue price is higher than the fair market value, then essentially you're saying that you got a premium for the CCPS.
Got it.
I mean, Upasak knows better. I just wanted to understand one last piece here from my perspective is if the ESOPs, the term that you have taken, IPO, M&A, dissolution, and you've taken the weighted average, and the weighted average comes say 3 years, and if the vesting does not happen, it happens say after 4 years, it's just a hypothetical case, would you still consider ESOP? So ESOP, whatever term that you're looking for vesting completely the shares, would you come based on the term that you're calculating in the Black-Scholes formula? Is that the basis?
And then we have to also consider one fact. In some cases, there's an accelerated vesting that may take place.
Okay. So whatever is the vesting based on that term.
Yes. And so vesting that would have occurred prior to an exit taking place. So in some cases, the way it is defined that a vesting may be accelerated upon an exit event. So even though you are vesting of 4 years, but if a company gets getting acquired after 1 year, then there may be an accelerated vesting that may be triggered, which means the reserve holders now can exercise their rights to to acquire common stock by exercising the option. In that case, you may take those options into your cap structure.
Yeah, so that's a concern because you have taken weighted averages for various scenarios, for IPO, for dissolution, for M&A, and vesting could be for one of those events also. So even though the term is less, then entire thing is vested is what will be is to be considered, preferably then.
Yes.
Hello.
Upasak.
Hi,
Hello.
Upasak.
Hello.
Hello.
I have just a question relating to that Series C matter. Now, in a post-money situation, the moment we want to derive at the value of the company, automatically the capital brought in by Series C, that will also needs to be taken into consideration in the DCF, which will again change the value of the company, and subsequently the Series 1, Series B, and the equity value.
Can you repeat your question, please?
I mean to say that I'm just referring to our previous discussion regarding issue of CCPS Series C. Now, just now it was told that we need to make a valuation on a pre-money basis and the post-money basis. Whenever we are doing a post-money basis valuation, then we also need to take into consideration the money or the cash brought in by issuance of Series C CCPS, which will again change the valuation. And accordingly, Series 1, Series A, B valuation will also change.
That's right. So
as on reporting date.
Correct.
As on the reporting date.
Yes.
So now I just heard a statement that in case the issue price is same in a pre-money and a post-money situation or Series A, then we will assume the fact that Series C has been issued in a correct method and on a fair value. But do you think that's a correct approach to say that in a post-money situation, when Series A value is also going up, that is actually affecting the value of Series C?
It will, because when the money is coming in the company, all the existing securities will be impacted by it, including the new money that came in. So we have to consider the impact of the new money and the rise and performance of new money on all the existing securities. So it's already 10 o'clock. So let's take.
Upasak, I have small last question. Can you go to column M, the allocation percentage which is determined? So is this determined based upon number of equities or is it determined based upon the value?
It is based upon the number of equity shares wherein they are converted into common stock.
Okay. So can you determine based upon the value as well?
Only in the case when you are getting a dollar value, in the sense you're getting a liquidation preference. But when you're getting paid as participating with common stock, your payment to you would be based on number of shares that you held in the company, that you hold in the company.
So meaning thereby when I'm doing a value as liquidation preference pe jata hu, then I need to determine the value based upon the number of this liquidation amount. Except in the same waterfall chart, I need to include beyond break-even point based upon number of equity shares, correct?
Yes.
Upasak, few participants asked before break if you can save this file and share it in chat.
Sure. So I'm unable to upload it. So I just emailed the file to you.
Yeah.
So it would be great if you can upload the same file in
This
chat.
filled in one people want. That older one, everyone has it.
Yeah. So should I just share that file with you since I'm unable to upload it on chat?
You shared it already? Okay.
I have shared it with you on an email. Since I'm unable to upload it on chat box, I don't know why, but some error is popping up for me.
Okay.
Shilpa ma'am, can you please email it to us also? Thank you.
Okay.
Upasak, are you referring to this filled in Excel file which you would have sent to me in 5-10 minutes?
Yes, before 2-3 minutes.
2-3 minutes. Okay. Yeah. Okay, I think I got it. Yeah.
Perfect. Okay, so we will take a similar example. In here, I've included one more CCPS along Series C CCPS. I've left this cells vacant for participants to populate it based on how we determine the issue price and number of shares in the prior example. Using a similar concept, this can be populated, and then so step one is to populate number of shares in issue price, and thereafter determine the strike price. So I will just say, okay, this is step one. This is step two. This is your step three. And then this should be auto populated because this is very straightforward. Once you get to step one, step two, and step three. So somebody asked whether we have MCQ. We do have three, four questions around this same spreadsheet. So once you complete all the steps, then you would be in the position to answer the poll questions, which are based on the value that you determine on a per share basis and for the strike prices. So you can take 10-15 minutes to populate it. So it's 10:05, maybe at 10:30 or 10:25. After 20 minutes, we can start discussing the responses to the case study. And in meanwhile, Shilpa, can you also open the poll question so that individuals who have completed a case study by 10:25, they can respond to it.
Okay, when should I launch the first poll question?
You can launch all the three at one go because they are interrelated. So you can launch them and individuals can fill it up after they complete this spreadsheet.
Okay, so I'm trying
Upasak.
to share.
Sorry, one small question, Upasak, again. So if I'm again coming back to the previous illustration, if we are issuing a fresh round of Series C CCPS, then we do not need to consider the option valuation. That's what you're saying for the fresh round?
If we don't, if we are aware about the fair value, then we don't need to consider it. But if we don't know the fair value of CCPS, in that case, we can do the allocation of value using an option pricing method or a simple waterfall analysis. That depends on the preference of the appraiser.
No, my fundamental question again is, will my fair value of my CCPS be different from my fair value of equity?
So fair value equity will be for the entire company.
Right.
And my fair value CCPS would be based on the rights of that underlying security because your
right.
stock may have different rights versus the CCPS. So yeah,
right.
Answer would be different.
They would be different. Thank you.
So should not we arrive at the number of shares to arrive at per share value for issuing the fresh CCPS?
Sorry, can you repeat?
See, in your case, the value is 125 or whatever the value. So I need to arrive at per share value to issue the fresh CCPS. So at what value I need to issue the fresh CCPS? So per share value would be arrived only after I know the number of preference shares that would be converted into equity.
Yes. That's right.
That's right.
Yes.
So in your case, the number of shares, where are those written? Those are converted into equity?
For this case,
in your example?
In this example, you are assuming 1:1 conversion of
no,
this.
these are achha, okay.
So we are assuming 1:1 conversion for this case study also.
Okay.
So you can individual participants can start with step one, figure out what the issue price may look like depending on the way we discussed on the previous example. Complete the pre-money and then divide the pre-money by number of shares outstanding, and then compute the issue price, determine the number of shares. Once you do that, you can move to step 2 of calculating the strike prices.
Shilpa ma'am, have you shared the revised Excel with us?
We have not received this fresh Excel.
So
it was shared in the chat as well as yesterday's email.
No, the revised one, having
revised
the
one.
Revised one, just now it is shared in the chat. Just now.
It is with a filled in. It starts with a filled in narration.
Yes.
So it's 10:08 right now. So at 10:25, we can regroup.
It is not downloadable.
Yeah, it says potential security issue detected.
Can you please email this, ma'am?
Yes, but still you can press yes and go ahead.
But it is not downloadable.
Which chat in the BBA members group?
No, here in this Zoom session chat.
It is downloadable. It is downloadable. It's asking for a security thread, but that file is downloadable. Just download it and rename it to .xls.
Okay.
I can't see that. Where is it?
Yeah, it is opening.
Shilpa, I can't see that. I don't know why in the close.
I just resent it again. Just 1 second before. Resend.
In this Zoom session, right?
In the Zoom session chat, file also can be shared. So that option I have selected. In the chats itself.
Yeah, I'm wondering why I can't find this in the. I got using iPad. So.
It will be great in case you can WhatsApp this or maybe email this to everyone.
But in iPad, I'm going to this chat facility, and in the chat, and I'm seeing it. I can't see at all any attachments.
Shilpa ma'am, can you please put it on the WhatsApp group if that's not a problem?
Mr. Upasak, I have a question. Can you just go back to the previous example file?
Yes.
And can you actually look at the issue price for in column E4? Should that not be adjusted for ESOPs?
Yes, that's a good question. Yeah, it should be.
And should we also check the price for yes?
I have shared 1 second, Kusum. I have shared in the BBA members group. I will be trying to delete it after 5 minutes or 10 minutes. So in BBA members, this field in Excel is just now shared.
Yeah, somehow we cannot locate it in this Zoom when we are using iPad. Non-computer problem.
Best if you can email us because I am not a part
Email,
of this.
I don't have option. Even I am attending the session. Even I need a break. It is circulated in BBA members WhatsApp group. Okay. Or
Yeah, thank you, ma'am. Thank you.
Received.
Received. Thank you so much.
Shilpaji, I am not in the BBA WhatsApp group. So can you add me? I have given my number, Rakesh.
I am also not in the VVA member WhatsApp group.
Are you not able to see it in the chat?
No, ma'am.
Everyone, majority of them were able to download it from the chat.
Ma'am, it's for people who are using other mediums like iPad. I mean, they're not able to see. So I think that's the problem.
I don't have the email IDs. I don't have the email IDs, please.
You add me on WhatsApp now. 9969410171.
That is a I'm not admin for BBA members.
Oh, so who is the admin? If he is
Ravindra is the admin, but that is for BBA members only.
So I am a BBA member also, but
Are you not there in BBA members WhatsApp group?
no, that's why I tell you.
We can see it in the chat and download from the chat.
Now I will send you both of you are in my WhatsApp group. I will send.
Okay, and also kindly add me on BBA WhatsApp group also.
I'm not admin.
Mr. Upasak, I also want to know if for E6 should it not be adjusted? Will it continue to be at 1 rupee, the issue price? In E6, cell E6.
Upasak has taken break.
Mr. Upasak, are you around?
Rakesh and Pranav, I have to forward it.
Kusum, he has gone on a break. His message, you can read his message.
Okay, I'm sorry.
I got it.
Poll is based on the case study, is it?
Yes.
Yeah, friends, I think you need to calculate and then type it. You guys have finished, is it? Or should I, if it's a mistake, I can cancel this poll and relaunch it.
I think you should relaunch at the end, because once the calculation is complete, then only you should launch. Otherwise, the many people have not done.
People are getting confused. I will end this poll. Okay, I will launch it once we resume from the break. Okay.
Yeah, let me have 5 minutes break, then I will work on that.
Yes, yes.
दर्द डॉक्टर का पानी
Friends, poll questions will be launched once we are all back from the break. That was just by mistake I tried to launch. That requires calculation.
Silva, actually, I want the details of. So, is this the only Excel file for which we need to do a working, or there are some other facts?
This is only one Excel file. Actually, I'm trying to send poll questions because you will not know what to compute, no? So I was just working.
Yes, actually, I have a question on how much is the issue price. So, from where should I get this issue price details?
We are all in the learning stage, so we have to wait how Upasak will take it. I'm just trying to put the poll questions in the chat so that you know what questions are expected in the poll. What are you expected to calculate?
Can see the example and the computation of issue price.
You see the example and calculate as per the example. Issue price will arrive from the formula.
Friends, the poll questions are mentioned in the chat so that you know what can be worked out. Once we rejoin, that time we will launch the poll.